Everyone, my name is Alaya and I'm from IPMI International Business School. Today, I will come back with another mind map. So I will explain about what I've learned for the whole semester in international finance. Let's get started. Four cornerstones of corporate finance. So we learned that the first cornerstone is the core value, and then second is conservation value, and then third is expectation treadmill, and fourth is the best owner. In value creation, we learned that the present value of benefits must exceed investment or cost. In other words, what we receive is more than what we give. We learned about the principal agent problem. So owners or shareholders hire managers to operate the firm. However, managers might not act in the ways that maximize the shareholder wealth. And there's issues on asymmetric information like adverse selection. It's when it's a market process in which buyers or sellers of a product or service are able to use their private knowledge of the risk factors involved in the transaction to maximize their outcomes at the expense of the other parties to the transaction. And for moral hazard, it's when an individual takes more risk because he knows that he is protected due to another individual bearing the cost of those risks. And the solutions to the problems that I've mentioned are first is write down a contract to motivate the agent to act in the interest of the principal and to establish protocols for agent surveillance. Another forms are GCG, training, better recruitment process, and then provide agent compensation in the form of stock options or deferred salary. And then for international opportunities, we learn about investment opportunities, financing opportunities, and then cost benefit evaluation for purely domestic firms versus MNC. So the marginal return of a domestic project is lower, and the marginal cost of capital is higher. So the profit at the end is lower, and then for MNC, the return is higher and the cost is lower, so they have a higher profit. We also learn about the international risk exposure, like the uh, exchange rate movements, foreign economies, and political risk. We learn about arbitrage. It's when two prices do not conform with the parity framework. We're creating a position to realize a riskless or sure profit from market disequilibrium. And the types of arbitrage are locational, you buy low, sell high almost at the same time, and then triangular, you buy at lower price, sell at a higher price, and it's usually happen during the crisis. And then covered interest arbitrage capitalizes on discrepancies between the forward rate and the interest rate differentials. In currency risk, there are transaction, economic, and translation exposure. So firms manage their currency risk by first operational techniques like geographic diversification, spreading the risk, gap limit, and natural hedging. And then second is through financial contracts, so like forwards and futures, options, borrowing or investing in local markets. And then factors for a hedging decision. It's assessment of the future strength or weakness of the foreign currency it is exposed in. It involves forecasting and how comfortable the firm is with the result of the forecast. And then they may not have any currency exposures and simply focus on their core business. Like if the firm is risk averse, it will decide not to sell the product or service overseas because it thinks that it can reduce uncertainty and potential volatility by avoiding fluctuations in exchange rates. Forward is a contract between two parties to buy or sell an underlying asset with a pre-specified amount, price, and delivery time in the future. There are spot price, like price for immediate delivery, and then forward price, price for future delivery, and delivery price, agreed upon price written in the contract. And then forwards are tailor-made between two parties. Meanwhile, futures are standardized and traded on an organized exchange. The types of future contracts are agricultural commodities, metals and minerals, and then foreign currencies and financial futures. An option is a contract that gives its holder a right to buy, call, or sell put a certain amount of a certain underlying asset with a certain predetermined price, like strike or exercise price, at a certain time in the future. The next is long call versus long put. So a long call option, for example, the exercise price of a stock is $50 per share and the premium is $3 per share. So each contract typically represents 100 shares, and the stock price has increased significantly and is currently trading at $60 per share. And then to exercise the call option, buy 100 shares at a strike price of $50 per share. we buy the 100 shares of company X at $50 per share, and then it costs us $5,000, and then we already paid the premium $3, so the total cost for us is $53 per share. And then current market price of company X is $60 per share, and then immediately sell the 100 shares at $60 per share, and we earn $6,000. And then the profit from exercising the call option is $6,000 minus the $5,300, and we earn $700. And then for the long put option, the exercise price of a stock is $80, and the premium is $5 per share. And then each contract typically represents 100 shares. So now suppose that the stock of company Y has dropped significantly and is currently trading at $70 per share. So to exercise the put option, we sell the 100 shares of company Y at $80. So we will earn $8,000, and then we already paid the premium $5 per share. So the total proceeds per share is $80 minus $5, which is $75 per share. And then the current market price of company Y is $70 per share, and we immediately buy back the 100 shares for $70 per share, and we get the profit of $500. Next, I'm going to explain to you about the arbitrage and put call parity. So since the payoff on a combination of a long call and a short put are equivalent to a leverage equity, the prices must be equal. If the prices are not equal, arbitrage will be possible. Swaps. So there's foreign exchange swaps. So the swap rate is the difference between the spot and forward transaction. And then interest rate swap is usually in the same currency and no principal exchange at the start. Periodically, there's interest exchange of fixed and floating interest. And then by the end, there is no principal repayment. For currency swap, there is principal exchange in the beginning. For example, the exchange of rupiah and US dollar, and periodically both rupiah and US dollar interest rate are exchanged at a fixed rate. So by the end, there is a principal repayment of the rupiah and US dollars. So currency interest rate swaps are combinations of the two. Foreign direct investment. So the motives for the foreign direct investment, first, MNCs commonly consider FDI because it can improve their profitability and enhance shareholder wealth. And then they are interested in boosting revenues, reducing costs, or both. Considerations for the FDI, before investing in a foreign country, the potential benefits must be weighed against the costs and risks associated with the specific country. And then second is review the foreign country's economic growth and other macroeconomic indicators, as well as the political structures and policy issues. So competitive advantages of Indonesia related to FDI is natural resources, because we have a lot of natural resources, and this is beneficial for sectors like mining, agriculture, and energy. And then labor costs. So Indonesia has a huge and reasonably priced workforce for businesses trying to find workforce for their production. And bonus demography. So demographic bonus is a valuable resource for the enterprise because the country's youth population is continually expanding. Some improvements to attract the FDI in Indonesia is to simplify the bureaucracy in Indonesia, and then lowering corruption index, and then improve the workforce quality. Next is green finance. So what is it? So green finance is any structured financial activity, a product or service that's been created to ensure a better environmental outcome. And why is it important? So first, it is important to solve the climate change, and then reduce the financial hazards, and encouraging the sustainable development goals. Green finance instruments, for example, the green mortgage, and then green credit cards, green bonds, green banks, and green loan. For the typical projects, so it includes renewable energy and efficiency, and then pollution prevention and control, and then biodiversity conservation, and circular economy initiatives. I hope you enjoyed the session, and thank you for watching.